Have you ever logged into your bank account, glanced at your balance, and noticed just a few dollars missing? It's usually not enough to trigger a full-blown panic, and it's definitely not enough to spend 45 minutes on hold with customer service. It's just enough to make you think, maybe I forgot about that coffee or that small purchase. Well, what if that tiny amount just keeps disappearing, month after month, year after year? Today, we're unpacking the systemic, often totally silent leaks in modern banking. We're going to look at why we're so prone to ignoring money that is literally slipping right through the cracks. Welcome to our explainer on the hidden drain of banking fees. We spend so much time focusing on making more money, but today, we're looking at the capital quietly eroding from our accounts.
Let's actually look at two people, Jake and Sarah. They have literally identical financial profiles. They're both 30 years old, same income, they both use standard checking accounts, and honestly, they both practice really sound budgeting habits. Yet, fast forward a decade, and a massive wealth gap has opened up between them. And here's the crazy part. There were no sudden promotions, no winning lottery tickets, no lucky crypto bets, nothing like that. They just managed the existing everyday infrastructure of their finances differently.
So, what's the secret difference? It almost always comes down to a silent drain: banking fees. Now, most of us think banks make their money primarily by lending out our deposits, right? Mortgages, loans, the whole shebang. And sure, that's absolutely fundamental to their model. But there is this massive secondary source of profit that flies completely under the radar: fees. Lots and lots of fees. Because they're usually so tiny on an individual level, we rarely give them a second thought. We kind of just treat them as an unavoidable cost of doing business, rather than what they actually are: an active leak in our wealth.
Take the standard monthly maintenance fee. $10 seems pretty negligible in the moment, but let's run the math. That small recurring charge silently compounds to a baseline loss of $1,200 over a decade. Actually, scratch that, it's worse. That's before we even account for the opportunity cost of lost investment returns. The real damage isn't just the principal you lost, it's the future growth that money could have generated for you in the market. Suddenly, a $10 charge doesn't feel like a simple rounding error anymore, does it? It becomes a real structural drag on your long-term portfolio. And then there's the incredibly common $35 overdraft fee. Think about that. Being slightly short on a $4 iced coffee triggers a penalty that is vastly disproportionate to the actual offense. Add in ATM fees, where you're effectively paying a $5 premium just to access your own money, and these costs scale up so fast. You're not being penalized for a massive default here. You're getting dinged for micro frictions in the system. When you add up all these touch points over an entire year, the efficiency of your cash flow takes a massive hit.
But wait, there's more. Beyond those heavy hitters, there is a whole network of micro penalties. We're talking foreign transaction markups that inflate your travel costs, paper statement charges just for getting mail, account inactivity fees literally penalizing you for just leaving your cash alone, and wire transfer costs. Individually, they just feel like tiny paper cuts. But systemically, they're pulling hundreds of dollars out of your ecosystem every single year. It is a highly optimized web of penalties completely designed to capture value from everyday behaviors.
So, that brings us to a really fascinating behavioral puzzle. If these cumulative losses are so incredibly high, why do smart, financially literate people just let this happen? Well, we are biologically wired to focus on acquisition. We analyze the side hustle. We fiercely negotiate the raise at work. We track broader market trends. But we have this massive blind spot when it comes to defending what we've already earned. We spend all our energy playing offense, and we totally neglect the defense.
And banks know this. They rely heavily on a behavioral economics concept called mental accounting. Look at it this way. If you lost $500 all at once to a pickpocket, your emotional response would be immediate. You'd panic, you'd cancel all your cards, you'd call the police, the whole 9 yards. But when a fee slowly drips out over 4 years, our brains categorize it as a trivial, recurring operational cost. We completely ignore the mathematical reality that the absolute loss of capital is exactly the same.
Think of it like a leaky bucket. Optimizing your income through promotions and strategic investments is fantastic, but pouring more water in is highly inefficient if you haven't patched the holes at the very bottom. You can pour capital into your portfolio as aggressively as you want, but if your structural foundation is leaking, you're just constantly fighting against your own progress. Earning more only accelerates your wealth if you are actually keeping those new earnings.
Now, how do institutions protect this continuous revenue stream? One word: friction. By adding just enough administrative burden to the process, the complex paperwork, the endless customer service queues, or just the pure hassle of updating your direct deposits, the immediate pain of switching accounts starts to outweigh the desire to stop a $10 fee.
These costs aren't necessarily hidden from us, they are just shielded by inconvenience. Human nature defaults to the path of least resistance, and I promise you that default is highly profitable for legacy banks.
To be clear, banks aren't villains here. They provide essential, highly complex infrastructure for our global economy. They protect our capital, they make rapid commerce possible, and they manage massive risk. The goal of this explainer is simply to empower you to interact with them as a fully informed participant. Because think about it, a smart consumer checks the price tag before buying something, right? Well, a smart financial strategist checks the fee structure before parking their capital. It is all about optimizing the relationship so it serves your growth, not just theirs.
All right, let's talk defense. Protecting yourself requires a proactive baseline, and we've got 5 concrete steps you can take today. First, you've got to audit those statements line by line. Don't just check your aggregate balance to make sure rent will clear. Second, deeply understand the specific fee triggers for your accounts. Third, maintain a strategic buffer above any minimum balances. Fourth, always use in-network ATMs. And fifth, let technology do the heavy lifting. Set up automated push notifications for balance drops. Let your phone manage the day-to-day defense for you.
Ultimately, this boils down to a choice between legacy convenience and optimized capital. The financial landscape has changed drastically, and it is fiercely competitive now. High-yield, no-fee accounts are readily available from agile, modern institutions. Sticking with an expensive, traditional bank simply because it's familiar, or because the friction to move just feels like too much work, that is an active financial loss. Don't let friction win. Embrace the competitive market. Shop around and allocate your money to institutions that actually reward your deposits instead of taxing them.
Because here is the truth. Building enduring wealth isn't just about spectacular market decisions or some viral windfall. It's incredibly pragmatic. It's the quiet, consistent discipline of minimizing unforced errors. It's fiercely defending the margins of what you have already earned. True financial momentum is built in the background by identifying inefficiencies and systematically, ruthlessly eliminating them.
So I want to leave you with one final thought to evaluate today. When you look at your own financial trajectory, is your primary hurdle really generating more income, or is it plugging the silent leaks? I challenge you, right after this explainer, open up your banking app and audit those line items. The most immediate, mathematically certain way to grow your wealth is simply to stop letting it slip away.